Hi, my name is Roy Thompson. I head up Carpenter Box Financial Advisors. With me, I've got Henry Wilson of LGT Wealth. So LGT are an investment manager that we use, and Henry works on that team in the investment management team there. So this is an episode of at the Coalface. The purpose of this is really to try and understand what's happening in the news and how that affects markets. So without further adu, sort of big news month, I guess, Henry, over the course of the last month when we recorded, perhaps about a month ago. I think we literally just had the mini budget, and we all know where that ended up. Kind of market turmoil, the whole Liz Truss regime, massively in the news. Everyone knows about it, and of course within the last week we've just effectively we have got a new prime minister. So what do markets think about this?
Yeah, it's been what a volatile month it's been, and the clear kind of ramification from a market perspective of Rishi's kind of selection as new PM is that the market is very much buoyed by his selection. So if we look at things like sterling has shown a bit of strength over the last couple of days, recovering a lot from the lows of that 1.035 that we saw just after the mini budget. And then also gilts. There was a bit of what we call a risk premium embedded into gilts. What that means is that people were so dismayed and uncertain with the UK spending plans and the fiscal deficit that was planned under Kwarteng and Truss that people lending the UK government money would require much greater compensation to lend that debt. What's happened since then, and that is reflected in the gilt yield. What we saw is that the yield on gilts rose much higher than the yield on a comparable sovereign like the US, so US Treasuries, which indicated that they required a much greater compensation for UK debt than US debt. And what we've seen over the last couple of days is that the difference between the two has shrunk a lot. And we've seen a much more kind of a normalization in UK gilt yields, which indicates actually that the market is becalmed. The market is much more comforted with the spending plans. It's much more comforted with the projected fiscal deficit. Of course, we still haven't had the OBR report, but the whole tone and messaging is that it's a row back, it's a U-turn, it's recognizing that we got it wrong. Hunt has been, he's spoken quite a hard line in terms of that he's going to get this sorted. And what was really interesting is the Bank of England Governor Bailey came out and said essentially that we are in harmony, we are in singing from the same hymn sheet, and that really indicated that actually we're almost back on track. It will take a bit of time for the market to be fully comfortable, but we're very much back on track in terms of portraying ourselves as being that kind of fiscally conservative, fiscally disciplined nation that we so long had a reputation for.
What does that mean for kind of individuals? So gilt yields went up, and you might say that they come back down, so that the capital cost of gilts, I guess what you're saying is works in reverse, so that they've gone down and they might have recovered slightly.
Exactly right.
But why this is important is because the government, when it goes to borrow money, is obviously doing it at a cheaper rate. So and that's an implication on us as individuals, because yes, we might go on to pay less tax, or it might be less inflationary. Is that a fair statement?
That's exactly correct. Yes.
Yeah. So these lower gilt yields, good from an inflation perspective, and obviously inflation is still, big news. It's exactly the item or the issue on the table. In that, it doesn't, internationally, it's very difficult to get control of inflation, largely because of the energy costs and supply issues that still remain. So the fact that the government has put themselves in a better position with the gilt yields, we think would be helpful for inflation, or is there any potential downside to that?
Yes. So, the positive of this is that we have, or the UK government have, sort of brought back a bit of credibility that had been absolutely hammered over the last couple of weeks. The flip side of it is that we should recognise that part of Truss's spending plans was to provide this energy price cap. Now, the energy price cap was going to cost £150 billion over 2 years, estimated. And the benefit of that is that it would cap energy prices, which meant that people's bills would only rise a certain amount per year, despite what happened on the energy price front. And that meant that even if energy prices rose hugely, the households would end up with more money in their pocket. Despite the fact that energy prices should have risen a lot, households' energy bills would be capped, and so those households would have had more money to spend in the local economy.
Yeah.
That would have meant that pubs, bars, restaurants, cinemas would have continued to receive good flows, good income, despite the fact that in kind of behind the scenes, energy prices would have risen. Now, the price cap was a good scheme in many regards, but it was quite crude in that it was untargeted, and it was clearly very expensive. Now, on the one hand, putting it there would have capped inflation, but on the other hand, it would have meant that the government would have been saddled with far more debt. And what's happened is that Hunt and Sunak have basically come in and said that they're going to make the energy price cap much more targeted, so that it'll be targeted at lower income families. It'll be targeted at those that need it most. So in April next year, it'll come under review. And that, to be honest, I think they probably will roll out some. They're not going to make it kind of entirely limited to just a very small group of people. But what it's meant is that inflation might rise in April next year for certain parts of the economy, which will obviously be bad. But it means that the overall debt burden on the government will be smaller, which is a good thing. So it's a kind of double-edged sword. On the one hand, it's good that the fiscal deficit position won't deteriorate massively. On the other hand, clearly it's bad that some parts of the economy will face higher energy bills. But these are unfortunately some of the difficult decisions that we have to face. We have to realise that the inflationary position post the pandemic it is very difficult, and governments have to decide whether they want to take on more debt or whether they want to face that fiscal deficit and try and turn it around, which will ultimately mean that our children and that those that are young don't have to face a position where in many years' time we have a huge debt position. So, good bits and bad bits.
So with that, if we, is it the case that with that, inflation might run on for a little bit longer, and therefore we might face a kind of, if you like, a more entrenched recession or a longer recession in the UK specifically? Is that a fair statement? And is that what investment markets have, in essence, already priced in, or that's what they feel is now likely to be the outcome?
Yes, so very much so. The Bank of England has indicated that we're probably already in a recession as we speak, and definitely it looks like we will see a deeper and more entrenched recession. If we have less money to spend down in the local economy, then that is less money that businesses will be earning, and we should expect a more deep and entrenched recession. And unfortunately, that is the price to pay occasionally to ensure fiscal discipline. The difficulty we have, I guess, is that it really raises the broader question of, is austerity back? People are quite concerned that you pivot from huge expansionary plans that Truss had to what looks like we might be in for a period of austerity, and people are rightly concerned that we might be heading back to the kind of austerity that we saw under Cameron and Osborne. And that was really damaging to the overall economy. Now, I'm not saying that we'll go back there, but people are, overall, I think people recognise that the UK does need to ultimately, at some stage, go back to being a pro-growth economy. Just sleepwalking into a kind of a low-growth, low productivity economy is not the way forward. But the flip side of it is that the spending plans were so huge and the timing of it was just so bad. And I think that most people will recognise that a period of low growth, perhaps a recession, is probably what's needed right now to ensure that we get inflation under control once and for all. And then once we're through that, perhaps we can start to think about reverting back to a pro-growth economy.
So individuals would hear about the word recession and they would fear, what that means for their investments, etc. Obviously, we already had pretty horrendous year from an investment point of view.
Yeah.
I suppose it's worth reminding us that the market does kind of forward price. So, what we're saying is that the market might have already arrived at the position that it's factored in a recession, and it's factored in these kind of high inflation positions. Is there anywhere, even sort of in the UK or perhaps over in the US, is there any indication that we might be getting to the point, people talk about the bottom, but a point where things might turn around a little bit? US inflation has started to level off just a little bit. So I don't know if there's any thoughts or comments on that.
Yeah, so let's take the US, because that is frankly the home of investment markets. It's really the where the whole of the world is focused on. It looks like the US will be peaking any minute now. So headline inflation has come down. That's the top CPI figure that most people focus on. The reality is that the Federal Reserve focuses on a whole range of other data points, and one of them is the core CPI data point, which extracts things like, takes out of the equation things like energy prices and food prices, which are a bit more volatile. And it's been a complicated story for core inflation, where you've seen things like shelter have remained quite robust. So what I mean to say is really there's lots of different kind of calculations and factors that you need to look at, lots of different data points, and we expect to start to see a peaking of inflation, and therefore a peaking of the central bank rate hikes in the coming months. We really do believe that we're nearing that endpoint now, and that should be beneficial for markets. So what we saw quite recently is US equity markets have done quite well over the last few days, and the reason for that is that on Friday of last week, the Wall Street Journal, one of the writers there, who's been very clued up over the last few months, he's always been able to predict what's been going on. He's had comments from central bank governors. He's had little remarks from people that have turned out to be that ultimately turned out to be true. And this same writer from the Wall Street Journal came out and essentially said that there's been some indication that we might see a rate hike of just 50 basis points in December or January, rather than the 75 basis points that we've been seeing, which would indicate that we're starting to get the correct kind of, the rate hikes are having the impact, that the desired impact that the Federal Reserve wants. And then there was a quote from one of the Federal Reserve governors saying that we can start planning for an environment where inflation starts to come down. So the messaging has ever so slightly just shifted. Look, we don't know. The Wall Street Journal is just the Wall Street Journal after all. But the writer has actually had pretty good success rate over the last coming months. So if he is right, then we're very much nearer the end of this than the beginning of it.
And an important message there is not that the rates are stopping to go up. It's just the rate at which they go up is the expectation is that will reduce.
That's correct. Sorry, I just got a small fire alarm going on. It's finished now.
No problem.
Yeah, so exactly. It's just beginning to realise, if they go from 75 to 50, and then the following month they go to 25, we can be quite clear that that people can see that we're getting towards the end of the tunnel, and it's all about that, being able to see the light at the end of the tunnel. I don't think that we should expect that if we hit, if rate hikes go to just 25, it's not likely that we'll suddenly go negative and suddenly they'll start cutting rates. That's unlikely. But what we might find is that they peak at a rate of, let's say, 4.5%, 5% in the US. And then we have a period of 3 to 6 months where they keep it flat, and then they start to cut rates at the back end of 23. It's all about where the terminal rate settles at, i.e., is it 5% or is it 4.5 or 5.5? And then for how long do they keep it at that level, and what's the messaging around that? And we might find that bonds start to do very well if they start to give quite good forward guidance that, we're going to settle at 5 and we'll do it for 2-3 months, and then we start to see easing at the end of 23.
Okay, so that's great. That almost sounds like there's a potential positive, I guess, is what we're saying for markets. I guess then, we spoke about the UK, new Prime Minister. In the last week, we had a new Prime Minister in China. That's not right. The existing Prime Minister has got in for another term. So what's the implication on markets for that?
So the immediate aftermath was that the market sold off quite heavily in China, and particularly some of the China tech stocks were really hit, Alibaba, etc. Some of them down kind of 20-30%. The funny thing is that everything that happened over the Chinese Communist Party conference was pretty much as the market expected. And yet, when it was confirmed what the market expected, the market sold off, which to our mind doesn't really make sense, because if anyone was expecting that he wouldn't be re-elected, that seemed pretty slim chance. And the fact that he was re-elected, therefore, was unsurprising. And also the fact that he then chose to surround himself with more of his close followers, more of those people who are likely to toe the party line. Should therefore be not a surprise, and yet the market didn't like it. The reason the market didn't like it is that he surrounded himself with people who look like they're going to continue with this zero tolerance approach towards COVID, which clearly impacts economic growth. But also he surrounded himself with people who are likely to continue with this quite hardline approach towards Taiwan, this quite hardline approach towards a more inward-looking China. So a shift towards focusing on their own, critical industries like semiconductors, defense spending, energy security, which therefore indicates that perhaps this deglobalization, this breakdown of one big global economy will continue, and that we should start to look at the world perhaps in terms of different trading blocks. So a kind of a Western trading block of the US, the UK, and the EU, and then a kind of Eastern trading block of Asia, China, Russia. That might kind of emerge. And so, we saw what we think was over-egged. The selling seemed to be over-egged, but Xi Jinping has been re-elected for an unprecedented third term. And there is some talk that he might actually end up now being the leader for life. So whether that's as president, or whether eventually he ends up being some sort of chairman of the party with another leader underneath him. But for all kind of, in essence, he will end up probably being a leader for life. That's what the market expects right now. So finally, not much changes, and yet the market didn't like it. And we'll see what happens. We're keeping a close eye on events.
I always think that the zero tolerance to COVID is quite interesting, because obviously their localized economy, it affects their growth, but actually, in my mind, it implicates supply issues around the world, because semiconductors, those sorts of issues, I don't think there's someone I know who hasn't had some sort of problem where they've ordered something and it's taken months to come through. And, in part that's because, or a good part of that is because of what's going on in China. So, has worldwide implications. So, Henry, that's been really useful. Thanks so much for your time. I think, the political position in the country is overshadowed every bit of news, but hopefully, whether we agree with policy or not, hopefully we can have a little bit of stability on that front. I think that would be helpful for the UK in general.
Fingers crossed.
But thanks very much, Henry.
Thanks a lot. Cheers.
Take care.